Prepare credit like the pros. Chapter 9. The inside scoop on credit scoring. Imagine you're a contestant on The Price is Right, with the giant wheel and host Drew Carey. Drew says spin the wheel. The number that comes up is your credit score. While you're reeling from shock, he goes on to say, if you spin a 740, you can buy a luxury home and get the cheapest financing. But if your marker lands on 600, watch out, because greedy sharks will come at you with hungry appetites to gobble up as much money as they can. And if you're really unlucky and spin a 480, then you can forget about having any kind of financial success at all. That would be a really rotten game show. And yet, that's what it feels like when you don't understand how the credit scoring system works. You have been told that the almighty credit score dictates whether or not you can buy a car or a home of your own, and what your interest rate will be. John R. Olsheimer, who spent 16 years working as a credit industry insider for Equifax and FICO, wrote in his excellent book, You're Nothing But a Number. The credit reporting agencies have more influence on your life than any other company. They are simply the most powerful companies in the United States. This is true because most financial dealings depend on the credit score system. Understanding how credit scoring works is no longer optional. It is mandatory for financial success. You must control your score. No more gambling on the big wheel of luck. Now is the time to take back some of the power from the uber-rich credit bureaus. When you understand the credit scoring system, you can literally control your own credit rating. You don't depend on banks, credit card providers, or anyone else. And you certainly don't depend on the spin of a wheel. Using your knowledge, or your new knowledge, you can make the right moves to gain credit points and stop the behavior that penalizes points. You can also take the initiative to fix mistakes of the past. Owning a high credit score saves you many thousands of dollars in interest charges, loan fees, and insurance premiums. What's more, you gain confidence for making financial negotiations because all businesses want to make transactions with people who have excellent credit. You receive approvals faster and easier than ever before. You gain respect from everyone you do business with. You are a good testimony to your family name and even your faith. As an encouragement, I shall share another success story with you. Another success story. Henry, a personal friend of mine, wanted to improve his credit score. Due to some investments that went bad, Henry had acquired late payments and collection accounts. Although he had paid off his collections, he still had a low credit score, in the mid 500s. Consequently, the mortgage on his home was at 9.25%. Then he took control. With my counseling, he was able to send letters that got the late payments and collections removed from his credit reports. His score rose to top tier over 740. He then refinanced into a 4.25% mortgage, lowering the rate he was paying to the lender by 5%. What a difference. On a $200,000 mortgage, that savings calculates to be $661 per month. It saves $7,932,000 in the first year alone. After a couple of years, Henry sold that home and purchased a newer, larger home in a better neighborhood that suited his growing family. What exactly is a credit score? Everyone talks about the credit score, so now it's time to understand what exactly it is. The credit score is a number between about 400 and 850 that grades you on credit worthiness. The credit score is an index of risk. It is an unbiased indicator of whether or not a consumer will repay a loan on time. The score changes as new information is added to or deleted from the credit file. On the day your credit report is pulled, the scorecard instantly tabulates your score by the information available at that moment. The score is based on all the credit-related data, not only on the negative data. Your established patterns of credit and payment correspond to the likelihood that you will make your payments on time or as agreed in the future, to use their verbiage. The following is a quotation from Explaining Experian, a document produced by Experian itself. Statistical analysis of data is used to define the characteristics that are most predictive of a consumer's future behavior. A scorecard typically contains a list of 15 to 20 characteristics, each of which is assigned points that reflect whether it is a positive or negative indicator of future behavior. Usually, the characteristics that are associated with high risk result in an applicant losing points, while those linked to likely good performance, a number of accounts paid on time, for example, will gain points. When the points for all the characteristics are added together, the result is the final score for each individual. How do the bureaus acquire information about you? Credit card companies, mortgage and finance companies, banks, collection agencies, catalog companies, magazine publishers, telephone companies, rental agencies, and more report payment data to credit repositories. Not all creditors report to all three bureaus. Thus, your score varies from Equifax to Experian to TransUnion. You might be shocked when you read this quotation, also from Explaining Experian, produced by Experian. Experian has a collection of databases that provide geographic, demographic, financial, and lifestyle information on millions of consumers around the world. This information allows Experian to offer highly targeted lists of potential customers to our clients, and to enhance the information held by them about their existing customers. Clients, quotations, companies, companies, seek consumer information, can make selections based on the profiles of their most profitable customers, or select from special lists, such as new parents, new homeowners, or investors. Wow! Did you know that they have a list of new parents and new homeowners? And that they sell your name and private information to companies so that they can solicit you for sales? As an example of this, Experian said Crate & Barrel, a retailer of household goods and furniture, used Experian to obtain a list of avid catalog shoppers. They sent catalogs to those people. Crate & Barrel also got email addresses from Experian. It seems the credit bureaus are making money every which way they can by collecting and selling our private information. Back when credit scoring was simpler. Originally, credit scoring was called bankruptcy scoring. Lenders wanted to evaluate the risk of loaning money to you. The loan officer had a paper scorecard with which to evaluate your chances of going bankrupt. He or she asked you questions, checked the boxes with a ballpoint pen, and then added up your score at the bottom of the page. How quaint, right? Then, in 1996, computerized credit scoring became the standard for loan approval. The California-based Fair Isaac Company created a complex mathematical algorithm by analyzing millions of credit histories and using up to 40 variables. His numeric scoring system enabled consistent, impartial evaluation of loan requests. It showed itself to be astonishingly accurate in predicting the risk of granting credit, most of the time. Of course, if you happen to be one of the exceptions to that, then the scoring system became maddeningly unfair. You don't get the same report the mortgage lenders get. Traditionally, when you request a credit report from Experian, Equifax, or TransUnion, a special consumer format is given, without scores. By contrast, lenders and banks receive a report in a more complete format, with a score page that assigns you a numeric score and 4 reasons why the score is not higher than it is. If you want to watch your score rise as you do your credit report, you can use a free website such as Credit Karma or Credit Sesame. That is fine. Just know that it is not your official mortgage lending score. Also, I recommend using a junk email because they will send you solicitations to buy services. When you are done with your monitoring, you can unsubscribe. Coming up next, why is the automobile industry using your credit score to set your auto insurance premiums?